Let's talk about buying a home and whether or not you can or should do this. I believe it's important to know all the details of your loan before you step into a 15, 20, or even a 30-year commitment. I'm going to break down the major concepts in a mortgage loan. We're going to talk about conventional fixed rate loans today, which are the most popular residential option and the one that I personally have. I'm going to break down all the details into simple terms, so don't be discouraged by all the numbers on this sheet. It's really not that difficult once you get the basics down. In green, we have the total payment. This is the total monthly payment that you're going to need to be able to fork over every month for the duration of this loan if you hold it to term. That simply means if you pay it off as they've calculated the schedule all the way to the end, 15 years, 20 years, 30 years. And it's based on assumptions that we're going to make that I'm going to walk you through making on this sheet. A lot of loan calculators online will give you a total amount, but it'll say this does not include insurance or property tax amounts. That can be a very big several $100 extra per month number. We want to make sure to calculate that on the front end. On the left side of this sheet are the amounts that you will change. We're going to walk through them one by one. On the right side of this sheet are loan amounts. These are calculated from what we go ahead and put in the column on the left. In the middle, we've already said this is our total payment based on everything in green right here. And then underneath here is a nice little bonus. This is the total interest paid per period of time. So this is comparing if you take a 15-year loan versus a 20-year loan versus a 30-year loan with all of our other assumptions in this sheet remaining the same. It's going to say how much you are going to pay in interest throughout those 15, 20, or 30 years. This is simply to illustrate and remind that if you can afford the monthly payment on a lower amount of years, you are going to be paying considerably less in interest over the life of that loan. You will have saved, in fact, $188,000 if you can afford the payment on a 15-year versus a 30-year loan over the life of that. That's $188,000 literally in your pocket or that never left your pocket. Okay, enough of that. Let's walk through the details. The purchase price is the purchase price. Pretty straightforward. Find this from your local market research plus your realtor. This is what you expect to pay for your home. I'm simply using $325 as an amount we can play with in this sheet. The down payment percentage you can find out from your mortgage lender. This is going to be hopefully 20%. On a conventional loan, they really want 20% down. Over here, you can see what 20% looks like. If you've got a $325,000 sticker price, you're going to be showing up with $65,000 plus additional closing fees. So add $10,000, maybe $20,000 to this. This is not everything you'll need to close, but this is the down payment amount. Depending upon your lender and your credit score, you may be able to qualify for less than a 20% down payment. This cuts this down significantly, obviously, in half actually. But be aware, if you bring less than 20% to a conventional mortgage, you are going to end up paying another additional monthly fee of mortgage protection insurance. This can be $50, $60, $70, $100, $200, depending upon the other details of your loan. It could be a significant amount that you're paying, similar to interest on your loan. It's just money going out the door. You're never going to see it again. If you can bring 20% to the table, this is advisable. The loan term is how long you're going to take the loan out for. As you can see, as you go up in the term amount, your monthly payment is going to be reduced. $1,863 on this total payment amount on a 30-year term versus $2,510 on a 15-year. So it's going to cost you, but you're going to end up getting that cost back in saved money and saved interest payments. The rate, this is going to come from your mortgage lender. Wow, 7.55. Holy cow. Okay. Your rate is going to change based upon many factors, your credit score, the current rates, market rates, etc. It's also going to change depending on your loan term. So it's going to be higher if you're on a 30-year than if you're on a 15-year. This may be, I don't know, up to 5.9%. They're very high as of the date of this recording. The annual insurance, this can be found out from your homeowner's insurance provider. You'll need to contact them with the details of your house. I've simply entered an amount that was similar to what we ended up paying in our market with our insurance for our home. Same with the annual property tax. This can be found out pretty exactly from your property tax assessor in the city or county in which you live. They should have a formula. If you look this up and Google your address, you're going to find your address's assessed value, the most recent one. And then there's going to be a formula. Ours was as shown here. The assessed value divided by 100 times 1.5540. Of note, the assessed value has nothing to do with the market value. This is for property tax purposes only and will be very different from the actual market value of your home. Now, from all these things over here, we have the loan amounts over here. 65 grand down payment, the actual loan amount that we're financing, the loan term in months. So when we select years here, it turns it into months over here. The monthly payment, this is simply the interest plus the principal. So this is what a lot of loan calculators will give you, not counting these big amounts, the monthly insurance and monthly property tax that are calculated from here. Do the research to find these amounts out. They can affect drastically the home you can safely afford. And again, here is our big number, 19/20/20 total monthly payment. Now, below in all these lines down here, don't be intimidated by this. This is simply called an amortization schedule. It's taking the loan amount, and this is coming from our loan amount up here. If I change the price tag, that will change accordingly. And then we're going to do a couple things to it. We're calculating the interest by taking the interest amount divided by 12 and multiplying it by this loan amount. That is the amount of interest. Can you believe how much that is? $1,300 in interest on this first payment. The principal amount, this is how much you're actually paying on the $280,000 loan amount on this first month. So you're only reducing the loan by $284. Watch what happens when I turn this into a 15-year loan. Now we still have a big interest amount, but we have a principal of almost $1,000. We're drastically reducing this more quickly, and we'll end up paying, as you can see in these calculations, much less in interest over the life of the loan. I'm going to leave this on a 30-year loan, though. This is what a lot of people will choose or have to choose. Over here, we're simply pulling down the insurance and tax amounts that are fixed. These will actually change year to year as the property assessment value changes and as the tax amounts change. So they'll do a yearly audit basically on your mortgage account, and these will go up or down a little bit. Now the total payment amount is another calculation that we did right here. This is just taking the principal, the interest, the insurance, and the taxes and summing them all together. The balance then is just simply the loan amount minus that principal amount. And I've left a column over here if you want to try to pay every few months extra toward the principal. This is a great habit if you can afford it. And this will be also deducted from the principal. Now down here at the bottom, you can see instead of taking that full 360 months, by making those principal extra payments way early in the loan, just those few that I entered in, it's actually reduced the time it takes to pay this loan off by 4 months. So that can also, in similar fashion to just making a lower loan term, cause you to pay things off a lot quicker. I've made this sheet for you to use in your own situation. Find the link, please, in the description below. I hope this is helpful for you. One final piece, if you'll notice this line right here, I'm going to go ahead and put borders around it because I didn't do that before. This is just calculating for you how much interest you're going to pay if you put those extra principal payments. So look, I'm going to put a huge $50,000 payment there. So now it's going to say, hey, you would have only have paid $158,000 in this exact amortization schedule if you did these amounts of extra principal payments. The ones up here in this box are simply taking the assumptions without any extra payments made. Hope that's clear and helpful for you. And actually, let's just go ahead and make a new sparkline graph here. So this will show you in proportion to this how much the interest will be. Hope this is helpful. Please hit like and subscribe to the channel if it was. You're awesome. Bye.